A stock is down 40% from its high. Your first instinct is that it might be a bargain. Your second instinct is that maybe it deserves to be down 40%. Both can be true. The market is full of stocks that look cheap and are cheap for a very good reason. The skill is telling the difference, and today I'm going to show you a 3-prompt AI system that does exactly that. Welcome to the AI portfolio. Every week, I show everyday investors how to use AI tools to research smarter, not harder. I'm not a financial advisor. Nothing here is financial advice. And you should always do your own research before making any investment decisions. This is not a get-rich-quick system. It is a framework for asking better questions about the stocks on your watch list. Before we get into the prompts, let's be clear about what we're actually looking for. An undervalued stock is not just a cheap stock. Cheap means the price is low. Undervalued means the price is low, relative to what the business is actually worth. A stock trading at $5 could be expensive if the company is losing money every quarter with no path to profitability. A stock at $500 could be undervalued if it's growing earnings at 30% a year. Price alone tells you almost nothing. You need to compare price to value. And that's what our 3 prompts are designed to do. Before you run any prompts, you need a starting list. You don't need to screen thousands of stocks. You need maybe 5 to 10 names worth investigating. Good places to start: stocks that have dropped 20% or more in the last 6 months, sectors that are out of favor with the broader market, companies that appear on value-focused watch lists or screeners on Seeking Alpha or Finviz, or simply companies you already understand, businesses in industries you follow that have had a rough patch recently. Once you have a name, pull up the company's most recent earnings report, investor presentation, or analyst summary. That's your input for the prompts. Here's prompt 1. Paste in the financial summary and ask, based on this financial data, summarize the company's current valuation multiples, including PE ratio, price to book, EV to EBITDA, and price to free cash flow. How do these compare to the company's own 5-year historical averages and to its closest peers? Is the stock trading at a discount, premium, or in line with history? What you're doing here is establishing a baseline. You want to know, is this stock actually cheap by its own standards? A company that normally trades at 25 times earnings and is now at 15 times earnings is worth a second look. A company that normally trades at 15 times earnings and is now at 14 times earnings is just a normal stock. The numbers alone don't give you a buy signal, but they tell you whether you're even in the right neighborhood. Cheap is only interesting if the underlying business is good. This is where most investors stop short. They find something that looks statistically cheap and buy it without asking why. Here's prompt 2. Based on this company's recent financials and any available analyst commentary, assess the quality of the business. Specifically, is revenue growing or declining? Are margins expanding or compressing? Does the company generate free cash flow? How strong is the balance sheet? What is the debt to equity ratio and interest coverage? Rate the overall business quality as high, medium, or low, and explain your reasoning. A high-quality business trading at a discount is a value opportunity. A low-quality business trading at a discount is usually a value trap, and value traps can take years to resolve, or they never resolve at all. The quality filter is what separates the two. Here's the part most value investors skip entirely: the catalyst. Even if a stock is genuinely undervalued, the market can ignore it for a very long time. You need a reason to believe the gap between price and value will close, and close within a reasonable time frame. Here's prompt 3. Given this company's current situation, identify the most likely catalysts that could cause the market to re-rate this stock upward over the next 12 to 18 months. Consider potential earnings beats, margin recovery, product launches, management changes, sector rotation, or resolution of a specific overhang. How credible are these catalysts based on the available evidence? If the AI struggles to identify any credible catalysts, that's meaningful information. A stock can stay cheap forever if no one has a reason to change their mind about it. Let's pull this together. Prompt 1 tells you if the price is genuinely low relative to history and peers. Prompt 2 tells you if the business behind the price is worth owning. Prompt 3 tells you if there's a reasonable path for that gap to close. You need all three. A stock that passes prompt 1 but fails, prompt 2 is a trap. A stock that passes 1 and 2 but has no answer for prompt 3 might sit on your watch list for years going nowhere. The power is in running all three and seeing how the picture fits together. Let me be direct about what to look for on the downside. A stock is more likely a value trap than a value opportunity when revenue has been declining for multiple consecutive quarters with no clear inflection point, when management keeps changing guidance downward and calling it temporary, when the debt load is heavy and refinancing is coming at higher rates, when every analyst has already downgraded and there's no remaining bull case. Cheap doesn't mean safe. Sometimes the market is right and the stock is cheap for a reason that won't go away anytime soon. Your homework this week: pick one stock from your watch list that has underperformed recently. Run all three prompts. See where it falls. Does it pass the valuation check? Does it pass the quality filter? And most importantly, is there a real catalyst that could close the gap? If it passes all three, it might deserve a spot on your serious research list. If it fails any of them, you've saved yourself from a potentially painful mistake. That's it for episode 19. Subscribe for a new video every week on AI and investing in plain English. See you next time.